Thank you for tuning in. Thank you for tuning in. In this episode, we're going to learn to trade the gaps. Stop Trading is live on this channel. I'm your host, Nandi. And as I learn to trade the charts, you are welcome to tune in. Tune in and listen. You are welcome to tune in and listen. All right. I can't tell if my mic it's never really. It's hard to tell if this mic is loud enough because the bars don't move like they should. Test, 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 test. All right. We're just going to move right on. Moving right along because I ain't got time to waste. We got things to learn. We got lots of things to learn. From my coffee. This is a Colombian brew. I don't know the difference. They're all all taste like cocoa to me. Sometimes they have these different um, cocoa that come from different countries, but I can't tell the difference. This one's good though. All right, let's move on. Um, you know, as it turns out, I can't share my screen on YouTube Live. I didn't consider that when I was doing this, so I should have gone live through Zoom. That would make sense, wouldn't it? So since I'm live here, dang it, gosh dang it. All right. Anyway, when you're playing the gap, when it comes to the stock market, if you understand what gaps are, uh, in a volatile market, you can benefit from large movements in the price action, whether it's to the upside or to the downside. Gaps are areas on the price chart where the price of the underlying stock moves sharply up or down with little or no trading in between. Usually this happens pre-market or after market. As a result, the underlying assets chart, it shows a gap in the normal price pattern. And what this looks like is sorry, I can't share my screen on the live. I just wanted to get to the point, share this knowledge with you, and then I'm going to record another one with Zoom. That way I can share my chart. So like I was saying, there's a sharp movement, whether it's up or to the upside or to the downside on the price chart. That's what gaps are. So if you're a skillful trader, if you know what you're doing, you're going to try to take advantage of these gaps to make a lot of money. There's certain criteria or things to watch for to give you a higher likelihood of, you know, getting a huge chunk of money out of that gap. Because sometimes these gaps can, there can be a price difference of like $5, $7. Sometimes they can be little, but either way, once the price starts moving into this gap, it's 90, a lot of times it's almost 90% chance that it's going to fail. Okay. Gaps have about a 90% chance of being filled. So when you spot these gaps on the price chart, you want to either set an alert and get ready to enter. Um, but we're going to talk more about it because you need to time it properly. You want to wait till the price has started moving into the gap or has already moved into the gap and before you enter the trade so you don't get faked out. Another thing to watch for is volume. Volume is very important when it comes to gaps. Don't enter the trade if you don't have enough interest or there's no volume or little to no volume on the on that particular time frame. The other thing that you want to watch for when it comes to gaps is that um, when you're dealing with gaps, they may be, even though it started moving, it can also reverse on you. So keep an eye on that. You want to have your stop loss in place, so, so that if the price turns around on you, you have your defense mechanisms in place, so you don't lose money. There are three important things to note here. That gaps are spaces on the chart that happen when the price of the stock significantly changes with little or no trading in between. Basically, it either goes up or down significantly without any trading. So, like I said, it usually happens pre-market or post-market. Gaps, they also happen unexpectedly um, because the perceived value of the stock investment has changed. So the underlying uh, fundamentals or technicals that relate to that specific ticker is the reason why those gaps happen. So you want to, I personally prefer to trade um, gaps on stocks that are well known. There are companies that have strong fundamentals. It's I don't trade no name stocks because one, there's more likelihood that there won't be a lot of volume in the little known tickers, and it might also take a very long time to fill. So unlike when you're trading a stock ticker like Apple or Tesla, and if it gaps up or gaps down, you have a good chance that there's volume there, as well as a solid chance that that gap's going to fill. And it's not going to take too long to fill either, because the price action is moving. So here are the basics when it comes to gaps. They happen because of underlying fundamental or technical analysis. If a company's earnings are much higher than expected, the company's stock may gap up the next day. What that means is that the stock price opened higher than it closed the day before, thereby leaving a gap. If you're trading the forex market, it's not uncommon for a report to generate so much buzz that it widens the bid and ask spread to a point where a significant gap can be seen. The other thing to note is that a stock breaking a new high in the current session may open higher in the next session. This will also cause a gap up on that price chart. Now, there are four types of gaps: breakaway gaps, exhaustion gaps, common gaps, and continuation gaps. Breakaway gaps happen at the end of a price pattern and signal the beginning of the new trend. Exhaustion gaps happen near the end of a price pattern, and it signals a final attempt to hit all-time highs or all-time lows. Common gaps can't be placed in a price action. They simply represent an area where the price has gapped. Continuation gaps, also known as runaway gaps, happen in the middle of a price action, and it signals a rush of buyers or sellers that who share a common belief in the underlying stock's future direction. You see a lot of continuation gaps in stock tickers like Tesla or Amazon, where you have a group of buyers or sellers that share the same sentiments, and they rush up and either purchase or sell off the underlying stock, um, and it causes a continuation gap. Let's talk about to fill or not to fill. When someone says a gap has been filled, what it means is that the price action has moved back to the original pre-gap level. These fills they're very common, and they occur because of one, irrational exuberance. What that means is that the initial spike may have been overly optimistic or pessimistic, depending on the direction, therefore resulting in a price correction. The second reason why you would have a a gap fill is technical resistance. When a price moves up or down sharply, it doesn't leave behind any support or resistance. And the final reason why gaps fail is that price action are used to classify gaps, and it can also tell you if a gap will be filled or not. Price patterns, rather. Exhaustion gaps are typically the most likely to be filled because they signal the end of a price trend. Continuation and breakaway gaps are significantly less likely to be filled since they're used to confirm the direction of the current trend. When gaps are filled on the same intraday, which they happened, this is referred as fading. And an example of this is, let's say a company announces their earnings and they beat their earnings per share the next opening day, market opening day, which essentially means that it opened significantly higher than it closed. If in this particular example, let's say that the day, as the trading day goes along, people immediately realize that the cash flow statement shows some weakness in that particular company. So the sell-off begins. This is what happens, uh, you know, because now remember that we had a gap. This gap opened on the same day and it's closing on the same day. So we call this fading. So eventually the price hits the previous day's close and the gap is filled. Many day traders use this strategy during earnings season or other times when irrational exuberance is at a high. This is why you don't hold on to stocks through earnings. You want to wait for the earnings report to be called so you know um, if they beat earnings or not, and then you can factor that into your next trade. So here is how to play the gaps. There are many ways to take advantage of these gaps. Some of the strategies are more popular than others. Some people trade on fundamentals, and some use technical analysis. Uh, Example is when you buy a stock after hours when a positive earnings report is released, hoping for a gap up on the following trading day. So the earnings report gets dropped and the company beat their earnings. So you preempt what you think is going to be a gap up the following day. So you buy there, you get into a trade the day before or after hours. Um, Another thing that traders do is that they might buy or sell into highly liquid positions at the beginning of a price movement, hoping for a good fill and a continued trend. An example of that is the traders may buy a currency when it is gapping up very quickly on low liquidity and there is no significant resistance overhead. Now, this is for Forex. Um, some traders will fade gaps in the opposite direction once a high or low point has been determined, often through other forms of technical analysis. If a stock gaps up on some speculative report, experienced traders may fade the gap by shorting the stock. Lastly, traders might buy when the price level reaches the prior support after the gap has been filled. An example of this strategy is basically, so just keep what you want to know here is that um, fade is a strategy when trading gaps, and fade happens when the gap is filled on the same day that it opened, and there are several reasons why it'll do that. Some traders will take advantage of this and actually use it uh, to fade. They'll fade gaps in the opposite direction once a high or low point has been determined. you know they they're running these charts, right? They're using technical analysis and they know they have their support and resistance. So when they when they have a feeling that a direction has been reached on one on a high or a low point, so they'll immediately reverse it, basically, try to fill up the gap and take advantage of it. So once a stock has started to fill the gap, it'll rarely stop because there's often no immediate support or resistance. This is an important thing to note too as well, because um, some people get out of fills early or gaps early, or they sell out early because they're not sure or they don't know when to exit their trade. A lot of times there's no gaps fill very quickly, so you want to know when to get out. You don't want to be in there expecting for it to fill 95 or 100%. Once you get about 75% in the direction that you were anticipating, I'll take that trade out, because you can't guarantee anything when it comes to stock movement. You can go up and down. You can reverse it, and you 80% in. So that's one thing to note. The other thing to note is that retail investors are the ones who usually exhibit irrational exuberance. Institutional investors, on the other hand, may play along to help their portfolios. So it's important to be careful when you're playing gaps and using indicators. You want to wait for the price to start to break before taking a position. This is what I said earlier. You want to make sure that the price action has started moving into that gap before you enter, because it can be a fake out. Exhaustion gaps and continuation gaps predict the price moving in two different directions. You want to be sure you correctly classify the gap you're going to play. Volume is a big one. It's very important when you're playing gaps. Be sure to watch for volume. High volume should be present in breakaway gaps, while low volume should occur in exhaustion gaps. So gaps are risky due to low liquidity and high volatility, but if you trade it well, it's an opportunity to make a lot of money. Bottom line is, if you study the underlying ticker or fundamentals, or do your technical analysis and due diligence, and figure out and understand what caused the gap. Is it newsworthy? Is it what caused the gap? Once you understand that and correctly identify the type of gap that you're dealing with, you have a higher probability of success. But there's always that chance that the trade will go against you. You can avoid this by watching the volume. If you start losing volume, or if there's no volume at all, then that's an indication that there's no interest. There's no interest in those contracts, and you want to get out. It'll give you an idea of where different open trades stand. If you see high volume resistance preventing a gap from being filled, then double check the premise of your trade and consider not trading it at all. You might want to just move on to the next ticker, especially if you're not completely certain. The second thing is that be sure that the rally is over. Irrational exuberance is not necessarily immediately corrected by the market. Sometimes stocks can rise for years at extremely high valuations and trade high on rumors without any correction. So be sure to wait for declining and negative volume before taking a position. Always be sure to use a stop loss when trading. It's best to place the stop loss point below key support levels or at set percentages, such as -8%. Well, my friends, that is your short and to the point education on trading gaps and technical analysis. I hope it brought you some value. If it did, leave a comment, like the video, and we'll bring you some more of this. Peace. Subscribe to the channel